Intel stock, ticker symbol INTC. This stock has gone up and down a lot in the past 5 years, but they are loved among the investors because of the dividends. Intel pays a juicy 3% dividend yield, which is growing at a nice and steady pace over the decades. But is Intel stock also a buy based on the fundamentals and because of the outlook? In this video I will show you everything you need to know about Intel. I will show you what they do, and I will show you my fundamental analysis to see if Intel stock is a buy or not. When I started analyzing this company, I ran into some interesting things I didn't know about Intel, so make sure to watch until the end. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analyses every week, where I will tell you everything you need to know about the stock market. So, what does Intel do? Founded in 1968, Intel's technology has been at the heart of computing breakthroughs. They are an industry leader creating world-changing technology that enables global progress and enriches lives. They stand at the brink of several technology inflections: artificial intelligence, 5G network transformation, and the rise of intelligent edge. The business can be divided into two segments: data-centric businesses and PC-centric businesses. They both have their sub-segments. When we check the revenue breakdown of the latest report, we see that client computing is the biggest revenue source, with more than 50%, but the segment is down 7% year over year. This is something to keep an eye on, because it might be dangerous that the biggest segment of 50% is decreasing in revenue year over year. But this also might be an incident. In this chart we see that over the past years the revenue of this segment is still up. The second biggest revenue stream is data center, roughly 30%. This segment is up 20% year over year, so that's really nice. The two biggest segments combined are already representing 80% of the total revenue. The other three segments only represent 20% of the total revenue, where Internet of Things is the biggest and is up 36% year over year. Mobile AI is up 7% year over year, and programmable solutions is up 50% year over year. So all the segments are growing except for the biggest segments. The full year results of 21 are quite impressive. They had their 6th consecutive year of record revenue and revenue records for the three segments. Next to that, they were able to raise the dividends in 2022 by 5%, which we will discuss later in the video. Some of the recent highlights are a 20 billion new leading chip factory, a plan to take Mobileye public in the US mid-2022, completing first closing of sale of the memory business, and the launch of the 12th generation Intel Core processor family. The last thing I want to show you is the demand for the chips worldwide. So not only the chips Intel make, but all the companies together. These chips are used in cars, phones and all other kind of electrical things. In the last couple of years, a lot of things have changed in our lives, meaning the demand for electronic devices is growing, and also the chips. So it's a bright future for companies like Intel. The only question you need to ask yourself is, will Intel still be the market leader in the next 5, 10 or maybe even 20 years? And are they capable of delivering quality and chips? This is something I simply cannot tell you, but it can highly influence the future of this company. So when you buy this stock, no matter what reason, try to ask yourself these kind of questions. So, with that being said, back to the stock again. Let's start with analyzing the historical performance versus some competitors. The first thing I want to check is the 5-year stock chart. In the beginning of this video I talked about Intel stock going up and down a lot in the past 5 years. And here we see that over the past 5 years, Intel stock is only up 28%, which is quite disappointing compared to the S&P 500, being up roughly 80%. And all relevant competitors are up more than 100%. AMD and Nvidia are up even more than 500%, but it has to be said that these companies have a lot of hype next to it, and that Intel is more in the range of fair value, while the competitors maybe not. More on that later in this video. The great thing about Intel is that it is seen somewhat boring, but a very steady company. So on the 6-month chart, we see that the S&P 500 is down 6%, and so is Intel. All the relevant competitors are down more than 12%, which is double the amount of Intel. My conclusion here is Intel isn't really going to give you a multi-bagger over the next couple of years. But it's a steady company which lets you sleep real good overnight because it's more valued right now in my opinion. And maybe even undervalued. But are they too boring to most investors? I bet you can make a lot of money by buying stocks like AMD, Broadcom, and Nvidia and so on. But sooner or later, stocks will hit their fair value, meaning undervalued stocks will go up someday and overvalued stocks will go down. And with that being said, it's time to check the fundamentals of Intel. Intel is a 186 billion market cap company, which makes them one of the bigger companies in the US, and they have an enterprise value of 196 billion. The current PE ratio is sitting at 9.4, which is really low for a semiconductor. And the thing is, when the PE ratio is too high, you pay too much for the company. And there might be some hype around it. But when the PE ratio is really low, this also tells a story. Maybe, and that's just maybe, investors don't like buying Intel that much and prefer other more hyped competitors. The forward PE ratio is sitting at 13, which is also really low. The other metrics looks fine in my opinion. The operating margin is sitting at almost 28% and profit margin is sitting at 25%, which is quite nice. Later in this video I will compare them versus some competitors. Return on assets is sitting at 8.6%, which is too low in my opinion. I want to see this number above 10%, so they are almost there. Return on equity is sitting at 22.5%, which is great. You want this number also to be above 10%. The 12th trading month revenue is sitting at 79 billion, and the quarterly revenue growth year over year is sitting at 2.8, which is not the highest. For a company like Intel, you want this number to be around 7 to 12% at least. In this graph we see the revenue over the past years. It's going up nice and steady. Back in 2010, Intel did 35 billion a quarter. In 2021, they did almost 80 billion a quarter. The gross margin is going down a little bit from 65% to 55% in the last couple of years. The operating margin and net margin are both going up since 2018, which is a nice thing. But this is something you want to keep an eye on. You don't want them to have lower margins in the future. The earnings per share is also going up nice and steady, which we see here. This is also because of the fact that Intel buys back a lot of shares, which we will discuss in a second. But first, let's check the balance sheet. Intel has a total cash of 28.4 billion and a total debt of 38.6 billion. They have enough cash to pay down a big chunk of the total debt, which comforts me a lot. Companies use debt to grow the business. Operating cash flow is sitting at almost 30 billion and levered free cash flow is sitting at almost 1.5 billion. For me, it's really important that free cash flow is growing because free cash flow is used to pay down debt, buy back shares, do acquisitions, pay dividends, and of course research and development. All very important for Intel. In this graph we see that the free cash flow is going up nice and steady, but took a big hit in the end of 2021. So this is also something you want to keep an eye on. But the great thing about Intel is that they buy back a lot of shares, as we see in this chart. In the last 5 years they bought back roughly 40%, which is quite a lot. This means the EPS will go up, which attracts other investors, and of course the total dividends paid will go down, meaning it's more easier for a company to maintain the dividends and to increase the dividends. These two things attract other investors and this will increase the stock price. My final conclusion here is that Intel has some great fundamentals, but the PE ratio is really low and I don't like that to be this low. Which sounds a bit weird maybe, but I think it's better to have an undervalued company with a PE ratio around 15 to 20, because there might also be a reason why it's this low. And in my opinion, it's because people don't see the hype with Intel, which they do see with other companies. But for now, I think they have the right strategy, with buying back a lot of shares, which will increase the EPS and hopefully let them increase the dividends even more. In the end, this will attract other investors. Since we were talking about dividends anyway, Intel pays a 3.40% dividend yield at a $1.46 annual payout. The payout ratio is sitting at 25%, meaning they have 75% of the total cash left for paying down debt, buyback shares and all other things. To be honest, I wouldn't mind when this payout ratio will be around 35% or maybe even 40%. This means a higher dividend and a higher dividend growth rate, because the 5-year dividend growth rate is only sitting at 6%, which is quite low in my opinion. But they grew their dividends for 9 years in a row, which is quite nice. The last thing I want to talk about are the fundamentals compared to the major competitors. I decided to focus on Broadcom, ticker symbol EVGO, AMD and Nvidia. The first thing that catches the eye is that Nvidia is by far the biggest company in terms of market cap. When we check the PE ratio, we see that all other companies have a higher PE ratio right now versus Intel. In my opinion, there's no winner here. Intel has a really low, maybe even too low PE ratio, and the other companies have a way too high PE ratio in my opinion. The price to free cash flow is also really low at Intel. I think FGO is the winner here with 16.95 and being undervalued. AMD and Nvidia do have a higher price to free cash flow, meaning you pay a premium. When we check the revenue growth year over year, we see why Intel isn't as hyped as the other companies. Intel only has a 1.5% growth, while FGO has a 15% growth, and AMD and Nvidia both have more than 60% growth year over year in revenue. The 5-year compound annual growth rate is also significantly higher at the competitors, and the net income compound annual growth rate is negative with Intel while the others have an increase. Overall, I think Intel isn't the winner here and other companies are doing a more better job. When checking the profitability, we see that FGO has the highest profit margin and Nvidia has the highest net income margin. Intel also has the lowest return on equity, return on assets and return on capital, which isn't a good thing for Intel in my opinion. When we check the balance sheet, we see that all companies are able to pay down most of their debt except for FGO. The last thing I want to check are the dividends. Intel has the highest dividend yield and also the lowest payout ratio, since I don't think the dividends Nvidia pays are needed to take serious in this comparison. FGO has a higher dividend growth rate compared to Intel, so that's also something to keep in mind. My final conclusion is that Intel is a great company, but maybe it's not the best company to own right now. You never want to pay too much for a company, but you also want to have some buzz around the company which enables them to grow and especially attracts other investors. To me, it feels Intel does a good job based on the fundamentals, but the growth doesn't really seem to be there. Compared to some other companies, I think Intel only wins the dividend battle, but in my opinion, this is not enough. So for now, I think I will skip Intel stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.